Woo! Here we go. Oh, welcome everyone, and it's 2023, so we're challenged with all kinds of new technology, and we're going it alone today. We've had some technical difficulties back at the world headquarters in the trailer. So, greetings everyone, and welcome to the show. I'm John Clay, your host and chief strategy guide, and welcome to the first edition of January 2023 and Benefits with John Clay. Everything is good here. We've gotten all of the Christmas stuff put up, and we're ready to launch right into headlong into the first quarter of 2023. And hey, look, 2022 was a shocking year. I think everybody can agree with that. And quick shout out to our sponsor, none other than Better Source Benefits. Check us out at www.bettersourcebenefits.com and see what we do to deliver options, benefits, options, and solutions. All right, got that out of the way. Against the let's talk about the economic outlook for 2023, because here we go. All the pundits and all the experts are weighing in on what's going on. Well, we're going to do a little bit of that with some flair, because what we know is that 2020 and 2021 were just volatile volcano eruption type years. And so many things going on, too numerous to name, but you are looking at the deepest global downturn on record, followed by the strongest rebound in 2022. Growth outcomes really bounced back in 2022 post-COVID, and it was still Jimmy Carter 2.0. So we're still faced with high inflation, a tightening of the monetary policy, and a whole raft of other repercussions that this creates downstream for everyday Americans. And if you were around in the late 70s and early 80s, you know that these things just don't turn around overnight. You don't just snap your fingers and you're in Kansas all over again, thanks to Wizard of Oz type stuff. So it's 2023. JP Morgan tracks 31 different countries, and under the last 2 years, 28 of those countries that JP Morgan tracks have raised interest rates. Under President Biden, the U.S. Federal Reserve has delivered a cumulative adjustment to 500% increase on money rates, on interest rates. And this is through the first quarter of 2023. They're expected to mercifully pause some of these rate hikes by the end of the year, but we don't know for sure just yet. Charles Schwab expects the economic growth and market performance to, improve in 2023 compared to 2022, but they're also saying that it's going to get worse before it gets better. So all these future forecasters, all the prophets are still working both sides of the street to be right in either case, right? So it's in other words, there may be more choppiness in the economy, and inflation is still noticeable. Although it may be receding, we still feel it at the pump and at the bread line. If you go drive through anywhere for a lunch, all of a sudden lunch is $10. It used to be $4. It's crazy. So here's the deal. The global economy is expanding at a sluggish pace, 1.6%. Financial conditions are tightening across the globe. They're not in an imminent risk of sliding into a recession, but we might see it. And here's where we're going to see it, right here in the U.S., of course. That's where all of the trends start, right? Look for the S&P to dip in the first part of 2023, back to the all-time lows. We've had a little surge in the fourth quarter of 2022, but watch that market after Christmas market just hit plunge again. We're seeing a 4 to 5% wage growth for wages. I said that twice. But we're also seeing inflation moderating back to 3 to 4%. I don't know yet, but they're saying that. The government gives us these figures, so they must be true, right? But here's the catch. Since we're raising rates and cutting benefits, so to speak, with the government pandemic bailouts and all this kind of stuff, what are people using? If they're not making more money, they've been blowing it out on their savings, and they're spending more money because they've got this artificially inflated bank account thanks to these pandemic checks everybody got. And the Fed's raising rates on things like homes and cars. Interest rates, when interest rates go up, we all know cars and houses go up. That's just the basic, any consumer loans that you have get a higher payment. So you got Jimmy Carter 2.0 continuing, because here's what the government wants. They're saying that they'll stop the raising of interest rates when we get inflation down to 2%, and when we get wage increases down to 3.5%. So wage increases right now at 5%, but when the government's going to lower the cost of money, when wage increases go back to 3.5%, well, nobody's living on a 3.5% raise. I don't know. Very few people are. If you got a 5% raise and next year it's a 3.5% raise, wow. And you've got, again, $10 lunches at the drive-thru. It's crazy. So that's what's most obviously slowing the economy across the country. And we're still in good shape as consumers, because we still have, hopefully, as a society, we have some of that money still left over from the pandemic bailouts. But they're making sure that we spend it out, because that's what the deal is. They want money to come out of your pocket into the hands of other entities, so that they can make that engine run. So if a person's not careful, between inflation and consumer spending habits over the next year, it may wipe out all the rest of that pandemic savings. And by the middle of the year, you're sitting there looking at vacations going, where are we going to go? Well, you might have to go to the campground. So credit card balance, here's the other big deal. Credit card balances are up 15% year over year. So at the end of the third quarter of 22 and into the fourth quarter, we've seen the largest increase in credit card balances in over 20 years. So you got consumer spending returning to borrowed money, which right now everybody's able to pay their bills and everything is good. But as those interest rates increase and the money supply tightens, then you start seeing the debts and the credit scores start to suffer. Right now, the average credit score is 760 or higher. 65 to 70% of mortgages originated in the last 2 years had that credit score of 760 or higher, and only 2% have a credit score of 620. This is a whole lot better than what you saw back in 2008 when the subprime housing crisis happened. But it's also starting to tighten up on auto loans, and student loans are going to be coming due now. If you remember, student loans have been put on hiatus for some time. People haven't had to make a payment on student loans for the last 3 or 4 years. And, once they start having to make those student loan payments, it's going to start soaking up a lot of resources, because what they promised that they're going to waive or cancel all the student debt, that's not happening. Guess who owns all that student debt? The government. What do they want? They want you to pay them back. There you go. Now you know the rest of the story. So you're also seeing some manufacturing slowdowns in spite of supply chain improvements. Quick shout out to Better Source Benefits supply chain management specialists here at Better Source Benefits for the medical supply chain, but we'll come back to that. So we're no longer in a rising tide lifts all boats scenario. When it comes to retail sales, COVID money brought growth in a few categories like furniture. People went out and bought new stuff with COVID money. They got furniture, they got home furnishings, they had new cars. You saw the car market really explode. That's why the used cars were so high, because you couldn't get the new ones due to supply chain issues like chips and things of that nature, solid states, chips and all like that. So, you know, the other bellwether is that you've seen significant slowing in the sales of furniture and home furnishings, but negative growth in electronics and appliance stores. So the department stores have seen a huge dip in sales because the COVID money ran out and the spending priorities have shifted. You know, even in the face of Christmas, we still have, you know, those statistics to wait and see what happened for the fourth quarter. So you got auto sales are better because you've got improved inventory with resulting chip shortages have kind of eased. And those sales are growing at 6% over quarter number 4, which is better than the 1% decline in quarter number 3 of last year. And you've seen lower new and used car prices. That's, again, supply and demand, simple stuff. If you got more availability, you've got less cost. That's the way it is. But here's the other thing we mentioned earlier. Restaurant spending continues at its highest in all retail sales. It's 14% increase year over year in October and 17.5% for the whole year of 2022. So that's, you know, you're buying the same stuff, right? You're still buying a sandwich, fries, and a drink, but instead of it being $4, $5, or $6, it's $7, $8, $9, $10. It's crazy. It's doubled, but it shows only a 17% increase. I guess the dollar menu ain't a dollar anymore. And then you also got travel. Look, everybody knows it was tough travel in 2022. And they're saying that the TSA input statistics show that we're almost back to normal with 95% of the 2019 level. So, you know, travel is back on the upswing, but here's the real takeaway. You've seen, and you continue to see the housing market activity stay low. Mortgage rates are way up. The 30-year fixed rate more than doubled from 3.25% at the beginning of 2022 to roughly 7% in mid-November. And with these high interest rates, who suffers? The homeowners, right? To return to affordability, to move out of your house and get a new one, what are you going to do? You're going to have to see a 10% drop in the cost of your house, the value of your home, to make up for the increased cost of money to borrow to buy new or to refinance. So that's a double whammy on the homeowner. And that's not really what we want as Americans, but I digress. Stronger dollar has the economic outlook mixed, both here and at home. We want a strong dollar here at home. However, a third of most of these large companies get their revenues from overseas. So a stronger dollar means that those products and services, mostly products, are tougher to buy overseas. and that leads to a decline in sales. So their profitability is lower because of our strong dollar. I like a strong dollar, but here's the reality. We're up 9% year to date over the euro from last year. We're up 11% over the sterling. We're up 22% against the yen. The U.S. dollar is. So they're going to extend that, but it's going to hurt some of these manufacturers and people who ship and sell goods overseas. So on the flip side, we're going to see supply chains getting back to a new normal, and there have been signs that constraints are easing. The shipping from Shanghai to LA at ocean freight rates are down from 80% from the beginning of the year and 83% from the peak in the second quarter of 2021. They're still above the 10-year average and the last 10 years, but you've got significantly improved delivery times. And the one exception is the China's zero tolerance COVID policy that continues to cause uncertainty for businesses reliant on Chinese manufacturing. Imagine that. China has still got their own problems, and they still want to put the constraint on us. You got the semiconductor chips and all that kind of stuff that they manufacture over there. They're going to start releasing some of that, but we've passed a big law here in the U.S. to bring that chip manufacturing over back on American soil, and the government has incentivized that. So we expect our chip manufacturing recovery to accelerate and be better. Well, speaking of supply chains, we manage the healthcare supply chain here at Better Source. And we do that for our clients who want to see a higher performance on their bottom line. So if you'd like to see some case studies and learn more, I would invite you to click on the Better Source Benefits website at www.bettersourcebenefits.com and click on the results tab, because you've got a couple of case studies out there. These are great starter introductory case studies. And I'm happy, of course, to book a meeting with me. Just hit that contact tab on our website and we can Zoom. I'm happy to invest 30 minutes with you to learn more about your business and see if these results can happen for your business. So that's it for today. It's a new year and a new John Clay coming to you from Better Source Benefits World Headquarters. Join us next week, same time, 2 p.m. Eastern, 11 a.m. Pacific for Benefits with John Clay, and we'll see you out there. All right, take care.